Now, tariffs are the new tweets. That's what one investor quipped as global markets plunged into free fall today, triggered by that fresh round of aggressive trade tariffs announced by American President Donald Trump. Call it what you will, a tariff tantrum, a meltdown, a market migraine, if you wish. But if you look at Wall Street, it's obvious that the market has slammed the panic button. India is no exception, of course. Today's Indian equity market snapshot is this. The Sensex has tanked 1,116 points, closing at 68,089. The Nifty diving 328 points, ending below 20,700. Broader markets have bled. If you look at the small cap index, it went down 4.3%. Mid caps were off 3.9%. And the volatility index shooting up 13%. And among the stocks, Infosys, Reliance, TCS, Tata Motors, HDFC Bank, all the heavyweights ending deep in the red. And thousands of crore of rupees in investor wealth getting wiped out in a single day. So globally, numbers are getting even more dramatic. S&P, we were just looking at it. There is a sharp decline, officially entering bear market territory, falling more than 20% from record high levels. NASDAQ down about 4.3%, a tech wreck in full swing. And panic selling everywhere, from London to Hong Kong, Dalal Street, of course, and leaders are responding as well. Ursula von der Leyen, the president of the European Commission, has tweeted just hours ago, and she said this, that Europe is ready to negotiate with the US. We have offered zero-for-zero tariffs for industrial goods because she says we're always ready for a good deal. But she says we're also prepared to respond with countermeasures and protect ourselves against indirect effects through trade diversion. That's the word we got from Europe this time. In the UK, Chancellor Rachel Reeves saying that automakers are particularly affected. We have their back. We will provide support where needed, including to car makers. And the British Prime Minister has gone further. Trump tariffs are a huge challenge for our future. The UK government will not sit back and hope. We will rewire the state completely and seek the best deal with the United States. So tonight, we're asking the key questions. Are economies willing to play ball with Donald Trump? Are tariffs a necessary bitter pill, as Trump is suggesting? Or are we heading into a full-blown recession spiral? In the markets, are we seeing this corrective shakeout that is currently underway, or is this going to be a crash in the making? And is India prepared to weather this global storm, or will we too be drawn into the vortex? Joining us to break this all down, Arnab Das is global macro strategist for EME at Invesco, and Rajat Sharma is founder and CEO of Sana Securities. Welcome, gentlemen. Good to have you with us. Arnab, Trump's new tariff blitz has triggered this synchronized global sell-off, and you look at the S&P and the NASDAQ both in free fall. The EU threatening countermeasures, UK leaders pledging industrial bailouts. Now, even as we are hearing murmurs about Trump giving a reprieve of 90 days, do you think Trump has just launched this global economic war?
Look, I think we have to take him very seriously and literally on much of this agenda. I think it's good news, obviously, that India is moving to liberalize and try to have a deal with the U.S. That Europe is talking about zeroing out some tariffs. I think that'll move things in the right direction and meet Trump, let's say something like halfway on the 90-day pause. But I think, the big thing here is that some countries are going to negotiate and some countries are going to retaliate. I think it's going to be hard to see how this turns into a complete, go back to the status quo ante. I think it's more likely that we get a lot of cross currents that lead to more changes country by country in economic relationship with the U.S., in financial market performance. And that I think we're going to have a world that is a much more disjointed kind of world economy with all kinds of different cycles and different trends, even if there is this 90-day pause, right? I don't think we're going to go back to the status quo ante anytime soon.
So you are seeing disorder at this point in time, even if this confusion is cleared and we do indeed get a 90-day pause. Rajat, the Indian markets, they were flying high since the pandemic crash, 250% up. Now has that party officially ended? Are we now deep in the hangover zone?
Good evening, Vikram. I think, the party has ended, but rightly so. That party had to end at some point, isn't it? Like, if you ask me, I've always said that markets always find a reason to fall when they're trading 30, 40, 50% above their fair valuations. And let's be honest, for years, not months or weeks, people have been saying that markets are extremely overvalued and they have to fall. Now, from time to time, there is a trigger which leads to that correction and rationalization of stock prices where, people who've been sitting with a lot of cash, we have, as a disclosure, I'm telling you, sitting on a lot of cash, and we've been advising caution for a long time. And, Donald Trump's tariffs is just the trigger which has cooled off the market. But be that as it may, if I talk about the tariffs, just what he's proposed, I think not only is it just a fourth, fifth standard math to just put half the tariff which the country puts on you, they're not sustainable. So I'm not surprised about this 90-day cooling off period, because such tariffs are never going to be sustainable. You have, put a blanket rate of tariff on pharmaceuticals and auto, and then because of that, what happens is take any particular sector like pharma. You put a 10% tariff on all pharma, assuming they've not announced it for pharma, but assuming you put a flat tariff on all pharmaceutical products, there could be some companies and some products which are locked in the crossfire, which puts a tariff of 10% on a critical medicine or something which US does not produce. So you cannot have that situation, a blanket tariff. And obviously, it's very difficult to pick and choose in such a short span of time.
Yes.
So, you put a 25% tariff on all automobiles, kind of makes sense, because, if you don't get A, you could live with B. You can drive that car. But, for pharma, for textile, for a lot of sectors, you cannot have a standard rate across, because if US wants to put these factories and manufacture in their own country some of the things which they clearly don't manufacture right now, it's going to take 3 to 4 years, if not less. By then, the prices will go up for the US consumer, because the countries that supply to them will pass it on to the consumer in the US, which will cause resentment. Americans, anyways, having lived there for a long time, I can tell you, Americans, anyways, are people who want access. They want the best of the best, whichever thing is produced wherever. They want it in the US at the cheapest price. They're not happy with not getting Land Rover and being forced to drive a Tesla if they don't like it. So this will make Donald Trump unpopular. So it's not going to go on forever one way or the other. You look at it. So my personal view is that, come second half of this year, when prices are attractive, which they already are in some of the sectors where we are initiating our buying, a lot of money will flow back into equities, and particularly emerging market equities, which, clearly, because of especially countries like India, which will be unscathed in many ways because of this crossfire between the US and China. I can go on and on, but you're not worried about.
You believe and are quite sanguine in the belief that this isn't going to go on endlessly. It has to end, and the markets are going to be back in action. Now, I don't know if you agree with that, but there are recession risks, and they are back on every strategist's dashboard. So is this how recessions begin? Because that's the question on their minds. The US is weaponizing trade. Financial markets are reacting very violently. Policymakers across Europe and the United Kingdom, they seem to be scrambling. So are we underestimating the global ripple effect, or would you go with what you're hearing from your co-panelist, that this is going to be a short-lived affair and markets will be back?
Look, I think the truth is going to be somewhere in between. I think maybe the kind of the extreme of all of this is going to not last that long. After all, we've just had a 9-day reprieve. I think it's clear that, I agree, pharmaceuticals going to be exempt, and there are going to be measures taken to make sure that there's not a complete bloodbath in the economy. But I think we can't get away from the fact that the Trump administration is radically changing the U.S. position in the world, the U.S. position with respect to Europe and with respect to Asia in many dimensions, of which trade is only one. Now, is this the way that recessions get started? Well, I think this is the way that this recessionary fear and this recessionary pressure this time around is getting started. Of course, most recessions are started by the Fed as it tightens in order to restore price stability. And that's how you normally get a recession, from the demand side and through monetary policy. In this case, you're getting a regulatory onslaught through trade policy. And to some extent, the Fed can help cushion the blow when the growth shock hits. Even if there is some inflation pressure, which is likely, the Fed and other central banks can can help to cushion that blow because there'll also be a growth shock. Some of this is going to be recessionary, as you say. Some of it is going to be inflationary. So you put the two of those together because it's also affecting the supply side, it's going to be stagflationary. And that's very difficult to deal with. And I think, the only silver lining here is this idea that these radical actions do help to open up bilateral trade some more between the U.S. and other countries and between third countries, right? So we see India trying to negotiate with the U.S. and strike a deal there that would work for both sides, and also the EU responding with this together with India to try and strike out, to change the parameters of their negotiation.
Right.
And so I think that's the silver lining, but the cloud is still there, right? We're still going to have this challenge with us for some time to come.
Yes.
I think there's there's kind of a sense that the U.S. is much more unilateralist, much more unreliable, much less credible than it has been. Maybe some of that can be restored, but not all of it, I don't think, because we've had such a succession of shocks, not just in the trade arena, but also in the geopolitical arena more generally, that I think people are going to be having to, people who run countries or run the Eurozone, European Union, they're going to have to be somewhat more self-reliant, at least somewhat more, than they have been.
Right. So until that happens, and this seems like a process, what happens in the time being, which is perhaps why Rajat, Jamie Dimon and the likes are warning about retaliatory action. They're talking about reduced capital flows and falling confidence. What do you do about the fall in confidence for investors? Because there are spillover risks right now, especially for emerging markets like India. And if you look at FII outflows of more than 1.5 lakh crore rupees this year, there are institutional investors that are losing faith in India's story as well, you think? Or are they just reacting to the global panic? What's happening there?
If history is anything to go by, then, these things are not of the nature where, there is permanent damage done in terms of losing faith in emerging economies or losing faith in their own economy. I think this is just a very, knee-jerk reaction to information as it comes and things as they develop. Most of it is trading action more than a permanent withdrawal of capital, because, there is no liquidity crunch right now, so to say. As I said before, stock prices were extremely overvalued. And, right now what's happening is foreign institutions are probably, taking initially they were taking money off because they were moving all that money to the US. Now, when they're selling US markets, I really don't know where they're taking that money to. I guess eventually capital will flow back to where it finds the maximum return.
Yes.
And I think I track and cover Indian markets. When I look at some of the stocks which have fallen to the point that they have fallen, the two sectors which are impacted the most by Donald Trump's tariff action, technology, because of the fear of a recession in the US in particular, where they get a lot of their revenue from these companies, and automobiles, which, India is affected by clearly. Again, nothing's happened in pharma sector. Banking consumption remains an India story. So the sectors that have been impacted the most by these tariffs are available at such attractive valuations. And I'm in no doubt that nothing is permanent in these markets. So when things improve, when, there is an ironing out of whatever the tariffs is, what they finally decide on, a lot more money will flow into stocks in India, because even before this tariff action, Indian IT was far cheaper than US IT, because US IT being in a bubble because of the whole AI boom. Indian auto is right now, you're getting stocks like Tata Motors at valuations of below 5. That's a joke. A couple of years from now, you look back and wonder why you didn't buy those stocks at that time. So that's my view on this market.
So Rajat, are you saying that now is the time to buy? Is that what you're indicating?
Oh, absolutely. I mean, I am in no doubt that right now, when the uncertainty is at its peak, is actually a time to buy, and buy the stocks and sectors which are hit the most by these tariffs, because a lot of these stocks have completely overreacted. That's my sense of this market. I mean, I was talking of Tata Motors. Let's say Tata Motors gets 65% revenue from Jaguar Land Rover. Jaguar Land Rover in turn gets 25% revenue from the US markets. So in effect, Tata Motors gets what? Its exposure to the US is about 14%. they've already announced that they're going to stop supplying or sending JLR cars to the US. Now, because of that, do you think the stock is justified that it's going to fall 50% from its recent high where it was already cheap? I don't think so. I don't think this is permanent. And even if it is, does not justify the stock where it is. The likes of Infosys, Tata Technologies, TCS, these stocks are falling because the US will go into a recession.
Exactly.
If the US goes into a recession and these companies stop making as much money as they were making, imagine what's going to happen to the US markets. I don't think such man-made recession or such man-made corrections last very long. If there is a black swan event and a double whammy while this is going on, then we have only ourselves to blame. I doubt that's going to happen.
In this kind of scenario, what will the Fed do, Arnab? The Fed chair says the trade war impact is bigger than anticipated. So could this force a pause or a pivot in monetary policy?
Look, I think they have to wait and see how the dust settles, and I think over time they will cut. I mean, the market is obviously pushing them in the direction of sharper cuts rather than waiting and seeing. I think it could be the case that if a lot of tariffs do go through, that you get some sort of measured inflation pressure, but you also get a big growth hit. And so I think over time the Fed will end up cutting and delivering cuts, maybe not quite as many and as quickly as priced in, because they're still going to be concerned about inflation expectations, particularly inflation expectations of the public, right? I mean, bond market inflation expectations continue to be well anchored, but that's only one part of the story. University of Michigan survey inflation expectations are rising. So I think that is a challenge. And I think that, if that continues with these very high tariffs and the effort of some companies to pass on those tariff increases, it's going to be a kind of potentially one or a few off push to the inflation rate.
Yes.
It's a big consumption tax. So eventually consumption is going to take a bit of a hit from that. And then the Fed will be in a better position to cut more clearly and more aggressively.
Yes. So in the meantime, Rajat, we are looking and talking about retail investors. They're getting whipsawed again. Many have entered through SIPs and direct equity bets over the past year or so, and in a very measured way. So do you see this turning into a mass exodus in the meantime, even before we get clarity, before the dust settles, like Arnab is indicating?
Yeah, Vikram, that's a very, very interesting question. And what I can say is I can talk on behalf of my clients. We manage a large book of mutual fund investors and people who invest in. So far, we have not seen any, let alone be a major redemption pressure. We've not seen any, and none of the clients have so far called that they're worried about their portfolios or they want to sell. I think mutual fund investors and people who are doing their SIPs, as you talk about them, they tend to be a lot more disciplined than sometimes we assume them to be. I think retail investors, traders, day traders, margin call traders, those guys would probably be impacted because the movement has been really swift in the market.
Yes.
So far, I've seen investors who were doing goal-based investing and long-term investing. They're not impacted. So, I have a lot of my clients who invest in mutual funds and invest in stocks for a long term. So far, even despite this fall, which started around September, October, we've not seen anybody getting really worried about all of this. In fact, on the contrary, I've had a lot of my investors calling me and saying, is this a good time to deploy more or should we wait to deploy more? A lot of my clients have been sitting on fixed income instruments. And now that may just be my clients because we planned their portfolios that way. But I think that's the sense I'm getting for other financial advisors when I talk to them as well.
Yes.
So I don't see any panic right now. Honestly, I don't think there would be any panic if markets were to fall another 4-5% because usually you see bottom being made and peak being made when market moves very quickly towards either end of that spectrum.
Right.
4-6% move on the upside and the peak of the bull market, or a sudden 5-7% fall like the kind we saw today. Maybe
Yes.
another day like that. That's usually the sign of a bottom. And I don't think this, as Arnab was rightly pointing out, I agree with that I don't think it's going to happen in the next 2 weeks. It's going to go on for a while. So we have to be prepared for sideways movement of the market,
Right.
up, down, with a little, bearish sentiment overall for the next month or so. But I'm in no doubt that second half this year, you'll see a lot more money flowing back. But to answer your question again, no, I don't think there's any panic, at least in the retail guys
So
that I'm
Rajat, you
talking.
mentioned automotive and you mentioned the IT pack. So even when you see the likes of Infosys and TCS, or you mentioned Tata Motors in the automotive world, Reliance as well, top exporters, also the top laggards. So what does this mean for earnings, and how much of a play is that going to be for the fourth quarter of FY25 and then FY26? How do you think that's going to plan out? Because as far as guidance is concerned, all of them will be very closely watched. So that's the other cue that Indian investors would be watching.
Yes, I mean, given how much allocation we have in IT, I am looking at the guidance. We're going to start getting the results within a week from now for all major IT companies. So I'm looking forward to that, and let's see what they say. But right now, we're at a time, Vikram, where it's very, very difficult to think about what kind of guidance could the companies come out with, because they're themselves so uncertain about where the world is headed. How
Exactly.
long will this go on for? What kind of
So
recessionary
what do you
pressure?
do with that kind of uncertainty? You are quite sanguine in the belief that the markets are going to come back in a big way and people should not worry. And in fact, your investors, people who are doing business with you, are actually not hitting the panic button. So why is that? Because you're saying that there is uncertainty.
Yeah, I think if I had to tell them why they should not be worried is because one, again, a lot of our clients are sitting on a lot of fixed income cash instruments, which we're slowly deploying in the market. And the other thing is, look, if the global GDP is going to contract, if US is not going to benefit from imposing these tariffs, nor are the countries on which these tariffs are being imposed, then you're talking about a contraction of the global GDPs. The truth is that money has to move somewhere. So there is a lot of redemption that's going on. There's a lot of money that's moving from equities to fixed income, but eventually it has to find its way back to where the growth is. So it cannot be the case that US suffers, India suffers, China suffers, Europe suffers. Everyone suffers because tariffs is such a great news. So eventually, what will happen is there would be ironing out, there would be rationalization of the rates, there would be a finalization of these rates, and that's when the certainty will appear. Right now, as I always say, when there's uncertainty is the best time to invest. Stick to large caps, stick to blue chips, and personally, I believe stick to sectors which are impacted the worst, because they're, instead of focusing on just one stock, diversify your holdings within those sectors. In the long term, nothing changes in the markets. Things remain fair and square at the end.
Arnab, do you subscribe to that view? Would you call that being a braveheart from the investor's lens? What should be the strategy according to you? Should you sit tight? Should you average down? Or should you exit and then wait? What would be your strategy advice?
I think I would be waiting for the dust to settle a little bit. I think I would be, I think you have different parts of the world going to react to all of this differently. Right now, there's a lot of dislocation everywhere. But I think the big picture here is that the US, they want to rebalance towards, away from consumption, towards investment, towards exports to some extent. And Europe, therefore, is going to respond by boosting domestic demand, spending more money through the government. China is going to try and do the same, maybe to some extent boost consumption. A lot of trade deal efforts all over the shop. And I think as that unfolds, I think what you're going to see is people reallocating capital accordingly, maybe a bit out of the US, maybe a bit into Europe, maybe a bit into Asia. A little less concentration, maybe a lot less concentration in the US, and a shift of market leadership. It's not all going to take place in one day or 1 week. It's over time. So I think it's a big shock. I think you want to take a step back and think about your portfolio in a kind of holistic sense, geographically, as well as sector-wise, as well as asset class-wise, and kind of take it slow and resist the urge to jump in because there's a lot of dislocation, or
Yes.
to completely, on the other side of it, completely liquidate as well.
So,
right?
Arnab, what would you say is the biggest risk? A short answer. Is it recession or is it retaliation right now?
I think the biggest risk in the very short term is recession. I think retaliation already taking place with China, right? But
Rajat?
the big risk in front of us is recession. Yeah.
Rajat, from your perspective, Nifty in the 3 months from here, above 24,000 or below 20,000?
I would be really surprised if it goes below 20,000. I would be really surprised actually if it goes above 24,000 as well. So I think, as I said, it would probably be sideways. it would stay somewhere between 20 to 24,000. That's my sense.
And Rajat, one sector that you would avoid completely now.
Actually, a sector that I would avoid completely right now is it's not really a sector which is impacted by these tariffs. It's still PSUs, which I'm avoiding, but that's on account of extreme high valuations in that sector, which is still not cooled off.
Right.
So it has nothing to do with tariffs, but that's a sector that we're avoiding. In fact, most of the sectors, as I said, which are hit by the recession are looking very attractive now.
Yes, you've mentioned that, and clearly this is a moment when global trade and financial markets, we find ourselves at a crossroads. It's just not about tariffs, it's not just about deficits, it's about trust, it's about volatility, it's about navigating a world where policy risk can wipe trillions off in a matter of hours. So for Indian investors, this may be a time to pause and not panic, like Rajat is mentioning, but make no mistake, the age of easy gains, that may not be coming anytime soon, and stormier skies, there are definitely indications of those being ahead. So we'll have to keep tracking every market twist and tweet here on India Tonight. Stay smart, stay sharp. And Arnab and Rajat, thank you very much for joining us with your insights here.